Hit it.
It's Friday, January 17th, 2024, episode 256. I'm Patrick Seresna.
And I'm Kevin Muir.
Pat, it's 2025, just so you know.
Oh my God, the typo. You know, I'm like Ron Burgundy. Just keep this in here. Like I'm wrong, but you said you fixed the date, Kev. Anyway.
This week we have the great pleasure to welcome Jay Mintzmyer, author of the Value Investor's Edge newsletter, which specializes in maritime shipping. We learn how to play this niche sector, and Jay shares with us a couple of stock picks that are poised to take advantage of the favorable macro backdrop of shipping. Then Patrick pulls out the nice thick crayons to tell us what's happened over the past few weeks in talking charts.
Yeah, and folks, we might even drink some beers along the way. What beer am I drinking here, Danny?
To be honest, Pat, I'm actually not sure, but it looks like it's a nice German wheat Pilsner.
Yeah.
Is that right?
Flensburg.
Yeah, I eyeballed that one.
Yeah.
I didn't do my research.
There you go.
While you're opening that, I just want to actually say to everyone, sorry we missed last week. We are on a little bit of a new schedule. That was mostly my fault. I had the good fortune to get taken down to New York City to be with my friends at StoneX. And just a big shout out to all those guys because we had a terrific time. And I got a funny story to tell you about some market huddle guests that I met up with at the bar afterwards. So we'll save that for the after show.
Absolutely. So Kev, why don't you give us a disclaimer, buddy?
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the inauguration investment impulse, the fiscal flashback frenzy, and the equity euphoria echo.
It keeps echoing, buddy. It just keeps echoing.
Patrick chose all those just to try to make me slip on the tongue.
There you go.
All right.
Let's get the guest on.
Well, it's our great pleasure to welcome to the show today, Jay Mintzmyer. He is the founder of Value Investor's Edge. It's a research newsletter that specializes in maritime shipping. Jay, thanks for coming on.
Absolutely, Kevin. Thanks so much for having me on the show. I'm excited.
And I'm going to give you a plug here. Our good mutual friend, Cuppy, he said to me, you have to get on the show. You have to get Jay on the show. He's a guy that quietly writes this stuff. He's been absolutely crushing it in terms of his calls. He's up, some obscene amount, and he definitely deserves a kind of some more exposure. So that's why you're here. You're here also to teach me about maritime shipping because I know absolutely nothing. I tried to give myself a little bit of a course beforehand, so you're gonna have to excuse it if I don't ask the smartest questions, but I am going to try to do my best. Why don't we just start with a little bit about your performance, if you could, because it is so impressive over the last little while.
Yeah, thanks, Kevin. And it's good to hear that I had a strong plug from Cuppy. I've known him for 6 or 7 years now. He's one of the early members of our platform. And so I'm glad to hear that he's been happy with our research as well. Value Investor's Edge was founded in 2015. I'd been following the maritime shipping sector for about 7 or 8 years at that time. And, I was still trying to find my place in the markets and where we could provide the most alpha. And shipping was one area where we consistently outperformed. And I believe that's because it's a really small cap space. Most of the market caps are anywhere from about 300 million to about 5 billion. So they're not penny stocks or anything like that, but they're small enough that most of the major banks and analysts don't spend a lot of time here. So there's a lot of pricing discrepancies. When we launched the platform, the first couple of years, it was just developing. We were finding our footing. We did tracked trades. So we'd recommend certain positions, obviously not investment recommendations, but just names that we liked. And so we did our tracked trades for a few years. In 2019, we launched long-only model portfolios. We have a value model that is exclusively in shipping, and we have a speculative model. And over the last, it's been about 7 years now with the long-only models, we have a 46% IRR. So that's about 10x over the last 6.5, 7 years. And, it's been a great time so far in shipping. There's been a lot of dislocations, and there's been a lot of exciting geopolitical events that have really helped out in the space and provided a lot of opportunities, both for investments and also for trading.
That's awesome. And good for you, man. That's absolutely terrific returns. Stunning, really, in this space that a lot of people barely look at and stuff. So before we get to your picks and your calls, let's learn a little bit more about you. Let's just start off with your name. I was sitting there, I was like, oh, J, and it's just the letter J. And I thought to myself, it must be short for J. And then you're like, no, it's, well, why don't you tell us what it is?
Yeah, absolutely. So my parents had the creative idea that they wanted to name me just J. I think maybe on the birth certificate it might be J period, but it's just the initial J. So yeah, it's always the conversation starter. People are like, hey man, what's your real name? I've known you for a few years now. We're in a circle of trust here. Is it James? Is it Jason? Like, what's your name? So yeah, it's just J, just a letter.
Your parents were marketing geniuses. They didn't even realize the huge advantage they were giving you. So let's talk about a little. Where did you grow up, and what's your background? Walk us through how you got to this stage in your life.
Yeah, absolutely. Well, I was born in Anchorage, Alaska. My parents lived
Really?
up there. Yeah, and they earlier in their life they weren't sure if they were going to have kids or whatnot, but so they had me a little bit later in life. They were around 40 when I was born. And then as I was growing up, my dad was a plumber. Had his own business, but it was just him, but a small plumbing company. And he was semi-retired pretty early, around 50.
Okay.
And so they started traveling down to Arizona, kind of like
All right.
snowbirds. And so I actually grew in the winter, we'd be in Arizona. So it's funny. I always say I'm from Arizona, but I had to split, my first 10 or 15 years, I split my life between Alaska in the winter in the summer and Arizona in the winter. And
So were you in
two
Anchorage?
different lifestyles there.
Were you in Anchorage?
Anchorage, Alaska. That's right.
Yeah.
And
So tell us like what it was like growing up as a kid there, because there's got to be some great stories. Like grizzly bears, like second nature to you, and Jesus, you're almost Canadian. Like I'm a Canadian, so I feel like you're kindred spirit growing up there.
Yeah, well, definitely, at least in the weather and things like that. And in the winters, of course, having 4 or 5 hours of sunlight in a day was very interesting. Thankfully, I haven't spent a winter in Alaska since I was in like second grade.
Okay.
So I haven't experienced a lot of the seasonal darkness or seasonal affective disorder or whatever the name is.
Right.
Sad. I've been too sad. but no, it was a very interesting experience. We did a lot of fishing, hiking. I did some canoeing and things like that. Never went hunting. So that's something I missed out on. I was just too young most of the time when I was in Alaska to do hunting.
That's awesome. That's a terrific story. You get the opposite, the fact that you spent summers there because you get the long nights, long days.
Yeah, it's fantastic. You go outside at like 10 o'clock and people like mowing the lawn and the sun is still up. And
I don't know if it's in Alaska or if it's in Northwest Territories. Somewhere there's a big golf tournament where they go 24 hours or something on the longest day. All right. So you're there. You kind of move to Arizona and then you go to school, or tell us a little bit about the next stage.
Yeah. So the first couple of years, kindergarten, first grade, second grade, first few years I was homeschooled just because we were traveling a lot and doing things like that. And my parents wanted that flexibility. I was only child. My mom was an English teacher earlier in her life. And so she had the skills to be able to, teach me some basic stuff. And, and then when we moved to Arizona, I started going to public school down there around second and third grade. And so I would split the time. I would, I'd go do about 6 months of the public school in Arizona, and then I'd go up to Alaska, and then my parents would kind of fill in the gaps and do the rest of the education. In high school, we moved full time to Arizona. So that's kind of when we made that transition full time. And that was my parents really sacrificing for me to let me, play football and do wrestling and do all the high school events down in Arizona.
Oh, that's terrific. And now, did you go to university, or what was the next part?
I did. Yeah. So I was in Arizona. I didn't know exactly what I wanted to do. All my best friends in high school were going to Arizona State. So that was the goal, is go there and have a great time. And this was back when Arizona State was like the number 2 or number 1 party school in the country. So that was my goal was to go to Arizona State and just have a grand old time. But I found out about the Air Force Academy. And actually all the military academies, West Point, Annapolis, Air Force. And so I applied to those schools just kind of offhandedly. I was like, oh, that's kind of cool. They pay for your education. You have a guaranteed job. You can serve the country for a few years. And I ended up applying to those, visiting all 3 of them. And I ended up going to the Air Force Academy, which is in Colorado. Okay. And so that's where I spent the next 4 years of my life there. And I wasn't sure what I wanted to do at first. I thought I was going to do engineering. And I got into advanced calculus and all that kind of stuff. And I said, I like math, but not that much math. Right. And so I settled on economics. And so that's really what started my sort of passion for the markets and learning about finances and things like that. And as far as trade and shipping, this is kind of a weird way to get into it. But when I was in Arizona, we lived about half a mile from a major train track. And so every 30 minutes to an hour, there'd be a big train going by with, 200 containers on it. And so I'd see all these different, Costco and Hyundai and all these different containers. And I always was fascinated just as a kid, I was like 14, 15. And I was always wondering like, what's going on here? And so in college, I started learning more about international trade and trade agreements and where all this stuff was coming from. And so that's kind of what threaded the needle and set me up for when I started getting into financial markets. I said, hey, well, what about international trade? What about shipping? What about this kind of stuff?
Right. And then you didn't finish it, like, although you went, and I assume from there you worked for the Air Force, but that wasn't it for your academic career, was it? What else did you do?
Yeah, so I got really fortunate at the Air Force Academy. Each year they send about 10% or so of the graduates straight into a master's program.
Oh,
so
okay.
I had the opportunity, very fortunate. I was like the alternate of the alternate of the alternate, but things fell into place and I was able to secure a grad school slot. So I went to the University of Maryland in Washington, D.C.
Okay.
And so that was fantastic because I had the opportunity. I was an intern at the White House Council of Economic Advisors. And I was able to study. That was when the Trans-Pacific Partnership was starting to develop. Unfortunately, it never came to fruition. There was too much controversy and too much bureaucratic mess there. But that sort of bolstered my experience in these trade agreements and in international trade and learning about national policy and politics. And so that was my next step education wise. Then I was back, in the Air Force. And after about 5 or 6 years in the Air Force, I had the opportunity to apply for a PhD fellowship.
Okay.
And so the Air Force sponsored my PhD research and they sent me basically they gave me a scholarship and they said, wherever you can get in, we'll sponsor you, you can go. And I was, again, very fortunate. Things fell into place. I was able to go to the Harvard Kennedy School in Boston. And so I spent about 3.5 years in Boston. And about 1.5 years ago, I finished that program, graduated, and I moved back to Las Vegas. And I'm currently active duty in the Air Force. I live here in Las Vegas. And that's why Vegas. People always say, hey, you grew up in Vegas. You like gambling. Like why, and financial market guy, gambling, trading, but that's all just a coincidence.
Wow. Now that is a terrific story. I love it because it's just so different. Can you tell me a little bit about what your thesis was for your PhD? Because I think it's particularly relevant right now.
Yeah, absolutely. So I show up there and I'm like the dumbest guy in the room. And I don't say that jokingly. Like there's some real geniuses here. But my background is all shipping, international trade, financial markets. And so I started focusing on these different trade agreements and tariffs and sanctions and what sort of impacts those would have on trade flows. And so as I was setting up my dissertation research, COVID was just kicking off. Okay. And so we had the supply chain crisis and a lot of things going on there. One leg of my research focused on how can we assess the true motivations of sanctions programs? Are they signaling? Is it for domestic politics? Or is it actually meant to disrupt it or bolster, domestic production and things like that? And so one of my case studies focused on what was called the China-Australia Coal War. So right after COVID, Australia was criticizing China a lot. And China was very defensive, of course. Okay. And so they cut off all the coal imports from Australia. And so that provided a fantastic case study. I was able to analyze all the coal trades worldwide and see what sort of deviations and diversions were happening. And I was hoping to discover, maybe that these were bluster sanctions and that China was actually doing some sort of triangulation trade. And, I was hoping to catch them red-handed. Right. Unfortunately, I didn't have like the Nobel winning research. I didn't discover anything tremendously suspicious, but I was able to compile quite quickly a pretty succinct summary of the global trade in coal. And then shortly thereafter, Russia invaded Ukraine. And that resulted, of course, in lots of sanctions against Russian oil and diesel exports. And so another leg of my dissertation, it was a 3 sort of journal article series. And the third leg of that focused specifically on all the sanctions against Russia. And so I was able to compile, after just about 2 or 3 months of the sanctions, we were able to find a lot of opportunism from India, importing a lot of that oil. And that's common news now. Like I think in 2025, 2024, even last year, everyone kind of knew that. But I was writing this in April and May of 22. So this was
it instant? Can I ask? I'm sorry to interrupt, but was it instant? Like did the market or did those particular actors figure it out really quickly? Like India's like, hey, wait, why don't you just write, and for those who don't understand, like Russia still sells their oil. They just ship it to India first and then India ships it to someone else. If I got it right.
Absolutely. Well, there's India is more just importing it. They're more just opportunistic. But there's a couple other countries, Saudi Arabia in particular, the UAE, and a couple other countries that we flagged in our research that were doing sort of the gamesmanship where they would import a diesel or oil and do like a the hair of refinement,
Oh,
just a little bit of refinement.
Just to be in compliance.
Exactly. So we were able to find a lot of those discrepancies, and it happened quite quickly. And that's the global free market, right? It's going to respond really quickly to changing events. And we were in an interesting scenario back in 2022, right? The oil prices were surging. Oil was over $100 a barrel. And the Biden administration at the time was very, very focused on taming inflation. Right. And so the sanctions were deliberately designed with loopholes everywhere. And that was on purpose.
So you think this was just a virtue signaling kind of, and they expected, I guess it really did hurt Russia a little bit in the pocketbook, but not like hugely. Is that probably correct?
Exactly. Well, the goal was to kind of crimp Russia's income from selling LNG and selling diesel and selling oil, but they didn't want to cut that oil off the international market. Right. Because otherwise you'd have $150 per barrel of oil. Right. So it was kind of, they were trying to hit two birds at one stone. They were trying to take $10 or $15 per barrel off Russia's profits without spiking the global prices. So that sort of threading the needle was successful, but it wasn't successful enough to stop Russia's war machine. Right. So that was kind of the gap there.
So just while we're on the topic of this, there was some announcements of the Biden administration in its final days putting on more sanctions. Why don't you tell us what was going on there, and is it just going to get reversed in a week's time?
Yeah, so I think it's very interesting. I think there's a sort of narrative that, President Trump is going to pursue a peace deal with Ukraine, or maybe not peace, but maybe like an armistice, something like we have in North and South Korea, where they're still technically, they don't like each other, but there's no military action going on. Right. And I think that's maybe the goal. And hopefully, for the sake of human lives and stability, hopefully that is possible. But how do we get there, right? And so I think there's sort of a narrative that, Trump is going to eliminate the sanctions and make everything, smooth and try to make the Russians happy. However, his top national security nominee, Representative Waltz from Florida, his number one push from day one is, hey, we need to actually do these sanctions correctly. We need to actually crimp down and not allow Russia to be exporting 95 to 100% of their capacity. Because right now they can export all their oil. They're just taking $10 of loss. Right. If oil is $70 and they're still making 60, they're still going to do okay. And so it seems that we actually might see more sanctions in terms of oil, or at least more enforcement of the existing sanctions. And so last week, the Biden administration rolled out a new set of targeted tariff or sanctions against specifically Russian-owned tankers and some of the so-called dark fleet tankers, which are those unlisted, unregulated tankers that are partaking in this sanction trade.
Got it. And so do you think that you anticipate this to continue, right? Because like that did cause the price of oil to spike, $5 in the meantime, as it might actually be becoming effective. And how did they sanction it? Like, because as you just said, is it just through a process of not allowing these ships to actually transport the fuel, and therefore it's kind of stuck at Russia's landlocked on their land?
Yeah, so it was kind of in two parts. So one part was basically all of European Union, the United States, Japan, and a few other countries agreed that they're not going to buy any of the Russian oil or diesel. So that was kind of part one. So taking away a lot of buyers from the market and forcing Russia into kind of a tier 2 market. So that was step one. And step two was all the ships that are insured by European sources can only transport Russian oil if it's subject to the oil price cap. And so at the time, the oil price cap was around $60 a barrel. That was supposed to be regularly readjusted, but it wasn't. So when the global price of oil came way down, the price cap was almost ineffective, because the price cap was roughly, $60 per barrel was basically the market price for Russian oil. So the sanctions were, like I said, they were kind of deliberately designed with a lot of these loopholes to keep the oil on the market. But the problem, twofold right now, the problem is one, $60 is not low enough to really crimp that Russian profit. And step two is we talked about kind of the free market and how it works and how it responds. And all the countries have kind of figured this out. So countries like India that import Russian oil, countries like China that have bolstered their imports. I mentioned Saudi Arabia had done some triangulation trades and things like that. So the market's kind of adjusted to this. So if you're really going to hit Russia hard and force them, because if you want to bring Russia to the treaty table, right, they have to be in a position of economic pain.
Right.
And right now they're definitely struggling, but they're not in the position of economic desperation yet. And if we want to get them there, the sanctions have to be ratcheted up and they have to be enforced.
Okay. All right. Let's get to the shipping. And as I mentioned, you're talking to a neophyte, so be gentle with me. Let's just start with explaining the different types of shipping that you follow and just lay that out. And then we'll go into where you see the most opportunities.
Absolutely. So one thing about shipping that it's kind of a misconception is folks treat it like a monolith. Oh, I'm in energy or I'm in shipping. But shipping is actually 8 or 9 different sub-segments of different types of vessels that have completely different supply and demand curves. And so just to break down a few of the categories, we'll start with container ships. So I talked about as a kid seeing the railroad cars and all that kind of things, the 20-foot or 40-foot boxes. You see them on trucks, you see them on the ships, you see them on the trains. That's all the retail goods, things going Walmart, Amazon, Target, all the stuff you'd buy there. And those container ships. And the other type of shipping would be dry bulk. So think iron ore, coal, grains. And we'll do just one more type. So tankers, crude oil tankers, a big floating bathtub full of oil to simplify it. Right.
Yep.
And so these ships cannot transport other types of cargoes.
Right.
So each ship, each type of, and I mentioned there's like 8 different subsegments. So each subsegment has its own supply. And so you have to look at the forward order book. You have to look at the age of the fleet, the replacement costs and things like that. And then you have to look at the global demand. So you might have one year where container ship demand, which is based on consumer purchasing appetite, that might be a bad year, right? If it was an economic slowdown, you might see that have a bad year. But on the other hand, you might see a market like LNG, liquefied natural gas, might have a strong year. Maybe it's a really cold winter in Asia. Maybe you have the Ukraine crisis. And now you have Russian gas that's cut off and Europe is desperate for LNG. So that's just an example of one year you might have a weakness in one segment. It might be a void, and you might have a very strong segment in another year. So you can stay in shipping and not be out of that overall monolith of shipping and still have different opportunities to do pair trades or have different types of market exposure.
Okay. Just a quick question on that. Container ships, so I assume when we're buying, cars, like let's say where the cars are getting sent from Japan, would they also be sticking computers on there? Like, would it be a mix of things, or do they specialize? And it's how does that work?
So interestingly enough, I'm glad you mentioned cars because there's an entire different segment of just car carriers.
Oh, geez.
They're almost like ferry boats and like a big floating parking lot or a parking garage, basically, that floats. And so that's an entirely different segment even. So yeah, that's just an example of how diverse shipping can be. But yes, in container ships, you could have computers, you could have shoes, t-shirts, furniture, appliances, all sorts of things, anything, and I always say simplify it. Target, Walmart, Amazon, basically anything you buy from there is probably on a container ship. Okay,
got it. And then dry bulk, I'm assuming you're talking about like when we ship wheat or soybeans to China or whatever. Does it generally stay in the one crop, or will they be able to put whatever they can fill it with? And how does it work that way?
Yeah. So some of the smaller dry bulk vessels have multiple different compartments and containers that they could fill up with different types of grain or things like that. But most of the dry bulk trade is focused on iron ore and coal. So that takes over 60% of the global dry bulk fleet is only in those two cargoes, iron ore and coal. And China is the importer of 55% of the global dry bulk demand. So it's really a China heavy trade. And it's based on China's manufacturing demand, right? For their factories and things. And also their industrial demand, new power plants, consuming the coal, and also infrastructure build out, right? China is building a lot of new skyscrapers, and a lot of roads and things like that. And so and bridges and tunnels, and that requires a lot of steel. And you use steel to get steel. You need iron, right, to get the steel. And you need the coal, the metallurgical coal from Australia to handle that. So yeah, the dry bulk trade is very heavily China based, and it's really heavy in iron ore and coal.
And so when we talk about the Baltic Dry Index, that's specifically that subsector of type of shipping, and that's the lease rates that they charge. Is that how it works? Is that per day? Well, how do you measure that?
Absolutely. So the BDI, the Baltic Dry Index, is a combination of the Capesize market, which is the largest ships, and again, mostly iron ore and coal, the Panamaxes, which are the medium-sized vessels, and the Ultramaxes. So it's a combination of all the different dry bulk routes, and it's formulaic. You can Google the formula and look that up. We won't get too deep in that, but it's basically the average rates or prices of dry bulk shipping. So I'm glad you mentioned the BDI, because a lot of times people will say, oh, the BDI is really strong, shipping's crushing it, or the BDI is low, the global economy is in severe danger, the BDI is going down. So it's a very seasonal index as well. So it's easy to look at it and get sort of false signals.
Oh, so they don't seasonally adjust it. So that's just the raw one. So you should be aware that it's dipping or whatever. What is the typical seasonality of that?
Yeah, so the low period in the Baltic Dry Index is normally around February or March. And that corresponds with the Chinese Lunar New Year, as well as the Chinese winter. And so during the winter in China, they also have a big slowdown around the Lunar New Year. They do New Year's correctly in China. I mean, it's like a month-long party and vacation time. Yeah. It's kind of like the Europeans, they take a month off in August. So the Chinese, they take like a month off in February. Got it. So the combination of the winter market and the Lunar New Year really provides a slowdown in the commercial activity in iron ore and coal. And so you see the BDI will almost always dip and trough out in February or March. And then you'll see it strengthen up into the summer. There's a little bit of like a lull into the fall. And then there's a big seasonal rush, usually in like October, November, December. So it's a very choppy, curvy market. And if you're going to compare things, you have to compare either year over year, or ideally taking like a 5-year benchmark of that seasonality. So you can't just look at it and say, well, it's down this month, because maybe you're going from like January to March and that's normal.
Right. And it's supposed to be down that month. Yeah. All right. So let's start talking about the opportunities that you see out there. And just like the fact that you mentioned there's different opportunities in different subsectors, you have favorite companies and favorite parts of the market. But before you do, why don't you pick one of them that you like best, but set it up from explain to us where the market had been kind of 10 years ago and how we got to the point where there's an opportunity now in that specific sector.
Absolutely. Well, we talked a lot about the BDI and dry bulk, so we'll go ahead and start there. Okay. And before I start, I'll preface that a lot of times our some of our top ideas or our biggest money makers are the ideas that sound on the surface, they sound kind of dumb. It's not like, oh, this is like, why is this guy into this market? Doesn't he know that China is about to hit a big recession? Doesn't he know that there's about to be a U.S.-China trade war, right? Like that's always where the opportunities are. Because in a small sector like this, the global consensus a lot of times is either wrong, or it might be correct on a macro basis, but they're missing out on specific companies, right?
Or,
the babies are getting thrown out.
And just to interject, in terms of when you're betting on that, if everyone knows something's going to happen, then it probably makes sense to bet the other way because it's already priced into the market. You don't have to actually be right. You just have to beat expectations, right? Yeah, and I'm assuming that shipping's the exact same way.
Yeah, shipping is a contrarian's dream sector. And you mentioned Cuppy at the start and how he's like the research. And Cuppy's also a contrarian guy, right? So event-driven and contrarian, and it applies very well to shipping. And it doesn't always apply to big sectors like tech, right? You can be a contrarian and be shorting Tesla and go bankrupt 100 times over. But in a sector like in shipping, a lot of times, absolutely. If you are in the 10% minority, a lot of the times that is where the gains are going to be made. So setting the table here on dry bulk, the dry bulk market went through a massive, massive bubble back in the late 2000s, 2006, 2007, 2008. China was growing their imports, iron ore and coal specifically at 25-30% year over year growth. And everyone thought, China's going to grow forever. We're going to have a decade of this growth. And China had, miles and miles of ships backlogged to get into their ports. China had insufficient import infrastructure to handle the growth they were going through. So not only was the growth surging, the shipping was very inefficient. Right. So in shipping, the supply and demand, supply is the ships on the water. That makes sense. But the demand is tons times miles. So anytime you have a shifting trade pattern or you have inefficiencies, right? If the ship has to go and wait 3 weeks to offload at the port, that is artificially consuming part of that demand, right? Because that ship is tied up and that ship is busy. So that's kind of what happened back then. And everyone saw the rates were skyrocketing. The break-even rate for a Capesize back then was about $9,000 to $10,000 per day. And the rates were about $100,000 per day.
Wow.
So, massive, massive margins. And all these old ships were employed and there's a shortage in the markets. And folks thought this could go on for a decade. And so there was a massive boom in orders. So the order book, the
orders for ships, just to make sure people understand. Orders for ships.
Yes. the orders for ships over the next couple of years, it was like the ships arriving in the next 3 years were 150% of the current global fleet. I mean,
Oh, wow.
Yes, phenomenal. I mean, it was just an absolute bubble. And it's easy to look back historically. I was quite young at the stage in time, but it's easy to look back at historically and say, how could people be so dumb? You know, this obviously wasn't going to last.
Yeah.
Well, you had the global financial crisis, and China did fairly well compared to the rest of the world, but they still slowed down because China's economy is based on manufacturing and exporting to Europe and other parts of Asia and the United States. And if all those other countries are going through a recession, they're not going to be buying as much stuff. And so China didn't have a recession, but their growth slowed tremendously after that period of time. And so you have this 150% growth that hits the water, and the subsequent decade. So from like 2009, 2010 up to like 2018, 2019, the rates in dry bulk were terrible. Cash break even at best. And that's operational cash break even, right? And so a lot of these companies were over leveraged because they bought all these ships at the top of the market. They took on 70, 80% leverage to buy these ships. So you had bankruptcies left and right in the shipping sectors. And right around 2019, 2020, we started to work through that glut of supply and the market started to balance out and things started to look a little bit more promising for dry bulk. And then we had COVID disruptions, and we kind of opened this up talking about Australia and China and all the disruptions there. And so dry bulk had a couple decent years. And right now we're at a phase in time where the supply and demand on a global basis is quite tight. We're not in a bull market. The rates right now are quite mediocre, but we've filled up all the slack. There's not a lot of idling ships or anything like that. And as we think about the age of ships, ships of high caliber, like a Cape-sized vessel that carries 180,000 tons of coal. I mean, the massive vessel. These things can only do about 20 years of tier 1 service. After 20 years, they're more dangerous. They require more expensive surveys every 2.5 years at that point in time. And a lot of customers, major mining companies, will not touch a vessel that's over 20 years old.
And the worrisome that like the ship will sink and you'll lose all your cargo. Is that basically it?
Absolutely. There's a mixture of things. The three biggest things, first of all, is safety, right? Environmental safety or crew safety, the ship breaking in half or something. That's pretty rare, but that is a concern. The other concern is a higher cost of surveys, special surveys, higher capital cost. The ship, it costs more to maintain, just like an old car, right?
Right. Okay. Fair enough. That's a great analogy.
Yeah. And the third thing is the efficiency of the engines of these ships. The technology has changed a little bit in the way the engines work. And so now with rising fuel cost and with more focus on reducing carbon emissions, it might cost $5,000 or $6,000 or $7,000 more per day just to operate those old vessels.
Oh, I see. Okay.
So there's kind of three factors there that keep folks focused on the new tonnage. Around 2013, 2014, there was major changes in hull design and engine technologies. And so I talked about that massive glut of ships that hit the market. And right now, over 1/3 of the global dry bulk fleet was delivered between about 2008 and 2011. And so we're working through, we're working through that giant glut. And that glut of ships right now, as we're talking, is hitting that 15-year point. So 15 is kind of like the tier 1 where people say, I don't know if I want to use that ship. And 20 is when it's kind of like obsolete. And so we're starting to move that glut from aging, not really tier 1, into obsolete. And so that's why we're quite positive on the supply side of this sector as we go from here through like 2030. That's the supply side argument.
And I assume the market is very efficient and has decided to build a whole bunch of ships for 5 years from now.
You think, right? You say, hey, we got to replace this tonnage, but everyone is so bearish, and it makes sense why. But everyone is so bearish on China and the growth of this trade that the global order book for Capesizes is 9%, and the aging at-risk fleet is 35%. So there's a clear mismatch here where folks not only are expecting a slowdown, it's almost like the market is pricing in like a 25% drop in demand, which would be, I mean, that would be catastrophic if that happened. I mean, we're talking global recession, 1930s. If that was.
Plus, it'd be fine because there's no ships anyways, right? Like the market's already priced that in, so it's fine.
And so that's the supply side. And I know we're going a little long-winded here, but that's
no. This is great stuff. That's the supply side story. Okay.
Yeah. And the demand side story here is, remember, the demand for shipping is ton miles. So it's not just the volumes, it's how far they're moving. And there's a massive iron ore project that's developing in Guinea, in Africa. And China is trying to diversify their sources of iron ore because right now they get about 60% of it from Australia. And we opened this up talking about they're not best buds. Right. And then they get about 40% from Brazil. And Brazil and China used to be a little closer with the BRICS and all that kind of stuff. But Brazil's been going through its own political upheavals and ups and downs. And that the Brazil-China relationship is a little bit tenuous as well. Okay. And so China is trying to diversify their sources of iron ore, as they should. I mean, that's just intelligent.
Makes sense. Yep.
And but here's the kicker here is that the Guinea mine that's opening up in 2026, start of 26, so less than a year away now, is 3 times the distance as all the Australian sources.
Oh, wow.
And so if you think that China is going to supplant some of those Australian iron ore imports with imports from their own funded mine in Guinea, mind you, right? A very, very friendly location for them. And so if you think about that, even if the total demand baseline is flat, doesn't grow at all, you're going to see a tripling of the cargo miles for that same iron ore. And so that's why we're very optimistic about this prospect. This is going to be about a year away. But at the same time, the demand goes up, the supply is going down because those ships are aging and they're not getting replaced.
Okay, so how do we play that if we were interested in that?
So in this sort of environment, you got to have a little bit of patience because, again, the demand story is probably at least a year away. The supply story is rolling basis starting now and going through about 2030. So this isn't a quick trade, right? It's not going to be probably 3 months, 6 months. It's more like 2 or 3 years. But we look across our index of covered dry bulk publicly listed companies, and we follow 8 of these companies. There's actually a couple more, but they're so small. They're like micro caps and they have terrible corporate governance. We don't even cover those. So we cover 8 companies. And of those companies, we look at the ones where they have good corporate governance. They have good shareholder returns. They have like a free cash flow payout policy. They have a repurchase program, things like that. Smart management teams that we've seen over the last 10 years have made the right decisions. So that filters the list from 8 down to like 3. Okay. So then we have to look at the fundamental valuations of these companies. And I've mentioned before in some of my discussions, but in shipping, a lot of the conventional fundamental ratios don't quite work. So like price to earnings. And that doesn't really work well for any cyclical industry because in a cyclical industry, you want to buy at the bottom, right, as things are recovering. Well, at the bottom, the earnings might be negative, right? So price to earnings doesn't really work. The other ratio that doesn't really work is price to book because book value is accounting. It just means when you bought the ship. So if you were like an idiot and bought all your ships at the top of the market, your balance sheet says all these ships are worth billions of dollars, but they're not. Right. So if you're using price to book, you'd say, oh, this company's really cheap. Right. Yeah. And if you had a company that bought all the ships at the bottom of the market, they'd carry all those ships with their book at below market values. So price to book can also be totally misleading. So sorry to divert there, but
no, it's important. I was going to ask you about that anyway. So we're good. I'm glad you covered it.
So the 2 ratios we look at the most, number 1 is price to NAV, net asset value. Okay. And so ships are a pretty liquid market. There's a sales and purchase market available where owners can trade their ships back and forth. And so we subscribe to several different data platforms that track all these global transactions in real time and provide us a valuation estimate on a per ship basis. So at any point in time on a daily basis, we can say the live NAV of any company. Right. So that's one of the ratios.
So like you're watching this and you're watching over a month's time that this ship, these guys, whatever particular ship type they have, it appreciated more than this. And so you're watching the NAV move around.
Oh, absolutely. Wow. And that's what makes price to NAV. Also, you got to be careful though, because it's a cyclical market. So at the top of the market, the NAV might be really strong. So it's another ratio that comes with caveats. All these ratios come with caveats. Right. But at any point in time, you can look and say, where is the equity market? Where's the stock market positioned compared to the asset market? And over the last 15 to 20 years, we've noticed the asset market is much more realistically priced than the equity. The equity market is very emotional, very psychological.
That's fascinating. Yeah. So the price to NAV will move up and down, and that's is your ARB because they're more filled with emotion.
Yeah, well, the NAV itself is more based on the owners and industrial companies that want to buy these ships, and they're looking at the free cash flow returns of operating the vessel. So that's a very more efficient market. It's like the real estate market.
They're more sober, pricing of the actual underlying asset. It's like the insiders trading here and then the outsiders trading the stuff. Okay, there's another metric that you use. Why don't you explain that one?
Yeah, so we try to look at mid-cycle free cash flow potential for these different companies. We say if we get rates back to like a median of the last 10 to 15, 20 years, what will be the free cash flow ratio? We can also look at EBITDA, but we prefer free cash flow because it incorporates the debt costs, interest costs, and things like that. But you can look at the EBITDA or the free cash flow at a mid-cycle point. And you can say if rates recover to a normalized level, how expensive is this company? What will be the free cash flow yield? And so we've done all these things. We've looked at all our different companies. And one of our favorite ones at this point in time, and I've mentioned it publicly a little bit earlier, is Starbulk Carriers, SBLK. And what we really like about Starbulk Carriers is they have a very clear dividend policy. They're paying out a minimum of 60% free cash flow, and they're using the other 40% discretionary. They can either do repurchases, they can continue to pay down leverage. Their leverage is already quite low, though. It's only about 25%, so we don't expect a lot of that. Or they could invest in new tonnage or renew the fleet. So it's a very clear capital allocation policy, and they've been very consistent with that over the last 10 years. They haven't done any sort of crazy deals or blown cash on things like that. And the other thing we like about Starbulk Carriers is the scale of it. It is the largest publicly listed dry bulk company, the largest fleet. I got about 170 vessels on the water, and it's liquid. I mean, again, it's a smaller market cap compared to, Apple or something like that.
Yeah.
But in shipping, it's several $1 billion. Yeah.
Right.
Yeah. And it's quite liquid. And so reasonable sized funds, even a $1 billion hedge fund could it put a 5% stake in Starbulk and be just fine.
Well, there is a reasonable size hedge fund with a 5% stake in Starbulk, and that's Oaktree. But I think Oaktree had sold some, right?
Yeah. So Oaktree is very interesting because they've had a lot. They're one of the few private equity firms that's had a lot of success in shipping. And the thing in shipping, they say a ship owners or an investors, a happiest day. They have 2 happy days: the day they buy a ship and the day they sell a ship. It's always hell in the middle, And Oaktree has the benefit of getting into all these shipping companies as parts of restructuring. So when these companies went over their skis back in 2010, 2011, and were going bankrupt, Oaktree got in there and they provided emergency funding, and they got all their equity for essentially pennies, maybe quarters on the dollar. We'll say that.
Right. So they were doing the old lend to own, right?
Exactly. And so they got in, the companies restructured their balance sheets, and Oaktree emerged with massive equity stakes. I think at one point, Oaktree owned like 55 or 60% of Starbulk. And so they got in there very cheap. And so they've made a lot of money. And now they're at the point in time where a couple of years ago, the dry bulk markets had done a little bit better, and they started divesting some of that. And they, I think on a book basis, I mean, they were up over 5x. So they were happy to take those profits. They still own a decent stake in Starbulk, but they have trimmed it down over the last couple of years. I don't believe I'd have to verify all the filings. I don't want to misspeak, but I don't think they've sold any shares in the last year or so. I mean,
well, I was just looking, they actually bought some recently.
Yeah.
So they're back on to back owning it. It must be a different part of their group or whatever. I'm not really sure. But yeah, you're right.
There was a merger. There was a merger there where Starbulk bought out another publicly listed company, Eagle Bulk.
Oh, maybe
Oaktree,
that was it.
Oaktree owned a stake in that, so that might have changed.
Oh, that's probably what that is. Yeah. So yeah, you're right. They haven't sold since when was this? Mid 2023. So yeah, it's been over a year.
Yeah. All right. So valuations are lower, and Oaktree is a smart owner, and one of the and we always say private equity and shipping is usually, I hope I don't offend. I don't know who all listens to this thing, but private equity and shipping historically has been one of the worst investors in markets. But Oaktree is an exception. And so Oaktree has had a lot of success in shipping.
Well, Oaktree are pretty smart guys. That guy, that Howard guy who runs it, seems to know a little too.
He seems to know some things. Yeah.
But investing. Now I look at this stock, and it's been down. Come June it was $26. It's now 14. It's had its troubles. Is that all in worries about China?
To boil it down simply, yes.
Okay.
China's been slowing down. And last year, there was a lot of optimism that China was going to stimulate the economy and dump billions and maybe even trillions of dollars into new infrastructure projects and stabilization projects. And that didn't really materialize. China focused most of their efforts on stabilizing their real estate sector. They have a massive real estate bubble. It's worse than the US's bubble in 2008. I mean, they have a tremendous problem there. And they've spent most of their resources trying to stabilize their real estate market. And they haven't spent as many resources as they have historically on building, new bridges and infrastructure and things like that. And so it hasn't helped the dry bulk sector as much yet. And so I think there was a lot of optimism a year ago, and that's probably why you saw Starbulk at like 26. And now there's a lot more pessimism. And then with the election of President Trump, people remember last time around in 2016, a couple months into the administration, tensions increased significantly between the U.S. and China. We had a trade war is kind of a strong word. I wouldn't call it that. A trade spat, maybe. And so people say, well, China is slipping. China is going down, and we're going to start kicking them while they're down and while they're slipping. And so why would you want to invest in a company that 55% of demand is dependent on China? Right. And so I'm not here to say like Starbulk being at $14-15, it's not shocking. It's not surprising. I'm not the market's stupid or anything like that. We're just saying we're looking ahead for the next 1 to 2 to 3 years. And we're saying we like dry bulk because of the supply and demand kind of arguments I laid out. And of all the companies we look at, Starbulk is certainly one of the best.
Now, just to kind of continue on that topic a little bit about a trade war, let's just assume that Trump does come out hard. And then let's just imagine that China stimulates even harder to offset the problems with, to the attack on their economy from Trump. That would, and just kind of thinking out loud here, but you might say you don't want to own Starbulk because it's a U.S. shipping company. But the reality is this is somewhat like crude oil in that if one company doesn't buy it, another company buys it. And it shouldn't really matter whose ships they are, right? Because it just switches who China ends up hiring. Am I correct?
Yeah, and that's correct. And Starbulk is U.S. listed, right? And they have a New York office. But this is historically a Greek shipping company. And all their ships are internationally flagged. So this is not, it's not like a U.S. built, U.S. Operated ship base. So we don't expect a lot of issues with the fleet itself. And we don't expect there to be, sanctions on dry bulk or something necessarily on that. But the concern would be that if China is struggling, China's entering into a slippery slope towards a recession, and then there's new tariffs and sanctions not sanctions so much, probably just tariffs that the Trump administration puts on, kind of kicks China while it's down.
Yeah.
If
and the
China
economy
goes if they go into a full blown recession, that's not going to be good for dry bulk. So I'm not going to sit here and BS anybody. Right. And that's why with a company like Starbulk, we're looking at their balance sheet. We're saying, what if, a bad case bear scenario, things are terrible in 26, 27. Is there a liquidity crisis? Is there a risk of insolvency? And with Starbulk, the answer is going to be no on that.
It's one of the better balance sheets.
Absolutely.
And I might push back and say that if Trump does hit them, it just means that they're going to stimulate all the more domestically. So you could argue that actually could actually be the best thing for the shipping is have Trump hit them.
And another argument to that too is that if China and the U.S. negotiate to try to close the trade gap a little bit, China is going to need to buy things from the United States to close that gap. And a couple things they can buy are grains, because the U.S. historically has a huge surplus. You always hear those stories about the U.S. just dumping agriculture cargoes in the ocean and things like that. So they have a surplus. The U.S. has a surplus of grains that we could export to China. China needs that. China has a massive pig fleet of pigs, lots of hogs in China. And so they need soybeans to feed the hogs. They would definitely like wheat as well. They import a lot of that from South America, but they could easily import some of that from the United States. The U.S. has a decent coal export base, Appalachia and the East Coast. And that is a massive ton miles, right? We talk about ton miles. And going from the East Coast of the United States, going through the Panama Canal and over to China is a massive cargo distance. It's far further. It's about 4 times as far as Australia to China. And
Don't you mean the American Canal or the Trump Canal?
Yeah. We'll see.
Okay, that's great. So, I'm just trying to think about why, in terms of summing this up, if you think that China, there's a deal with Trump, you could argue that it actually is very positive for this. At the same time, I might even argue, even without a deal from Trump, it just means that the China stimulates more. So really the kind of worst case scenario is that China, their economy continues to just meander lower and do badly. And we drip. And even then, it's pretty cheap. It doesn't hurt you that much.
It's probably dead. It's probably dead money is your risk. I mean, the risk is that you buy Starbulk today at 14. I didn't see the closing price, but 14 and change. And then, in 2 years from now, you look at the stock and you're like, oh man, it's still $14.
Right. Okay.
And that's sort of what we see as the bear case. Yeah.
Got it. All right. You have another sector that you really like and another name. Why don't you walk us through that?
Yeah. So the other sector we're following quite closely is the crude tanker area. And crude tankers are quite dynamic because they've benefited a lot from two recent events. The number one event they've benefited from is the sanctions on Russian oil and products, which have caused a lot of inefficiencies. We talked about how the global market has responded to those sanctions, and it responded quite well, but it required a lot of triangulation trades, required a lot of arbitrage, a lot of ship rerouting, and that increased the ton miles because the ships had to do less efficient routes to respond to the sanctions. And so shipping costs traditionally in something like crude oil, it's like 2 to 4 or 5% of the cargo cost, depending on the ship rates. So even if the shipping rates double or triple, you're talking about 25 cents per barrel of oil, right? It doesn't change the overall market yet.
Okay.
Yeah. It's one of those cyclical sectors where it doesn't have a lot of end impact on the global economy, and which is good for shipping investors because shipping rates can go up 5 times and demand doesn't fall off.
Okay.
And so that we like that side of it. The other thing we like, and it's quite similar to what I said on Capesize dry bulk markets, you have a similar thing in VLCCs, very large crude carriers. These vessels carry 2 million barrels of crude oil. So,
wow.
2 million barrels. Yeah. So fantastic amount, talking about 100 million gallons of gasoline equivalent in there. And these vessels historically, when they were designed back in the 1970s, when these vessels first hit the water, were designed to bring oil from the Middle East to the United States. So that was why these things were designed. That trade's no longer existent. The United States is not dependent on the Middle East at all for oil. And so now the primary trade is from the Middle East to Asia, China, Japan, Korea, and India as well. And so that's the primary trade now in VLCCs. And so in VLCCs, we saw something similar to what we saw in 2006, 7, 8 with Capesize vessels. We saw a big boom in orders. The global fleet is about 900 vessels of VLCCs, and they last about 20 years. That's about how long you can use these for. Now in a boom market where rates are $100,000 a day, can you squeeze 22, 23, 24 years? Maybe, right? I mean, you're going to spend $5 million to upgrade that ship if you're making $100,000 a day.
It seems to me the consequence of something going wrong from an environmental point of view is much higher though in a VLCC than a dry bulk.
Much higher. And so a tier 1 trading company, they cut off even sooner. So in dry bulk, we said about 20 years was the cutoff. In VLCCs, 15 years is like a hard cutoff. For a company like Chevron, Exxon, Vitol, Trafigura, like they won't touch anything over 15. And so once you get past 15, you're dealing in sort of the second tier, third tier markets, Africa, India, things like that. And so in the VLCC market, it's even more dramatic than Capesizes. You have about 40% of the fleet that's aging and getting past 15 years, and you have a resupply, an order book of 7%. So you have 40% of ships that are aging, going to be pushing away from the market, and you have a replacement capacity of 7%. And just to put that quickly in numbers, I'll try to keep the math simple. There's about 900 ships on the water, and they last about 20 years. So just using simple math here, that means every year to hold the fleet flat, you need about 45 ships to hit the water. 900 divided by 20, right? 45. Yep. And so last year in 2024, we had 2 VLCCs arrive.
Wow.
And we've never seen something like that before. So it's just a remarkable.
Like that was an all-time low in terms of number of ships that were built.
Yeah, it was that was an all-time low, and it was obviously significantly less than 45. And let me pull up. I'm going to pull up the chart here just so I don't want to speak out.
While you're doing that, where do they build these things? Like who builds?
Right now, primarily China builds almost all the ships.
Oh, okay.
Yeah. And the United States has not been competitive in shipbuilding since like 1970s or 1980s. In the 80s and 90s, there was a lot of push over to Europe. Europe was building the ships cheaper. Then there was a push over to Japan. Then Korea got into the market, and then China came in and just undercut everybody. And so now China builds over half of the global ships.
Wow.
Yeah. So just I pulled that chart up. So 2 ships hit the water last year. And this year in 2025, we're expecting 4 ships to hit the water. So in 2 years, we have 6 vessels hitting the water, and we definitely need 90, and we're getting 6. And so there's a huge amount of pessimism priced into this market.
Is that also a function of everyone assuming that oil is going the way of the whale blubber, and that we're not going to need it anymore because we're all going to be using electricity?
Absolutely. The fossil fuels are going the way of the dinosaur. And that is, that's exactly what that is. It's sort of a global ESG sort of trend or macro funds and hedge funds, private equity shops, they don't want to touch this stuff. Sovereign wealth funds, especially in Europe, have mandates to divest anything related to fossil fuels. And so a ship that carries 2 million barrels of crude oil is even if these funds might think the economics are interesting or attractive, that's not something they want on the books. They want more NVIDIA and Tesla and
doesn't that make it also actually more dangerous? Like, isn't that kind of the irony of this? Because we're not changing demand. It's not like we're actually changing what we're using. And yet now we're having a situation where don't have enough ships. So we're squeezing more out of shitty old ships and increasing the chance of an error.
And that's where those sanctions come in, and the so-called dark fleet, which is mitigating those sanctions. And it's providing a lifeline for these vessels that are 20 plus years old that otherwise nobody would touch these. And the only reason anybody's touching these vessels is because it's owned by some private person in the Middle East or Eastern Europe or Russia or something who has some sort of a series of shell companies and is now the proud owner of 5 Rust Bucket VLCCs. And if anything goes wrong, right, if there's an environmental catastrophe, good luck tracking down who's responsible for that.
That's just terrible. It's so dumb.
Scary,
like it's ridiculous. Like it's one of these things, again, we're too busy virtue signaling instead of actually looking what's actually happening with the economics. I remember hearing a story of someone that had gone and I think it was, I can't remember if it was pre-COVID or post-COVID, but there was a period where they were trying to get money for oil companies, like buying, funding actual, wells. Mm-hmm. And it was something like, it must have been pre-COVID because I think the bond yield was like 0 or 2%. And everyone was looking for the kind of nice, safe 8 to 10 or 12%. And these things were yielding 15 to 20. And they would try to sell it to guys. They would go to these pensions and these endowments and these sovereign wealth funds. And they said, listen, usually we would be all over this. This would be the greatest thing in the world. This is exactly what we're looking for from a cash flow perspective, but we can't touch it. And it's just like stupidity.
Yeah. And I hear that anecdotally all the time because Value Investors Edge, we've been around now. We'll be celebrating our 10th anniversary in May of 2025. And so we have over 800 members on our platform, and several of these members do run medium to large size hedge funds, or they manage family offices or things like that. And I've heard anecdotal notes from these guys all the time of say, hey, 10% of my fund is in shipping and energy. And that's been the best 10% that I've got for the last decade. But it's the 10% that every time I do my annual letter or, my clients see my fund holdings, that 10% of my holdings gets 90% of my questions and pushback. And people are like, why don't you just divest this stuff? Don't you know it's going away in 5 years? Why don't you buy more, biotech stocks or, and that's what I hear all the time is that, it's like this pressure of like, this has been our best 10%, but I have to divest it because everyone hates it.
Yeah. Okay. I interrupted you. You were talking about the setup being very similar in VLCCs versus the dry bulk shippers. And specifically you must have a name that you like. Why don't you, if you're willing to share with us?
Yeah. And just one last point here. And I think this makes the VLC segment even maybe a little bit more exciting than the dry bulk. We have 2 ideas, 2 different segments, totally non-correlated. But the thing that makes the VLCC segment a little bit more interesting as well is if we finally see a crackdown in sanctions and targets against this dark fleet. Because not only is this allowing Russia to continue to export their oil and diesel, which we should not be happy about, it's also a looming environmental catastrophe. I mean, we're potentially only 6 or 12 months away from another Exxon Valdez type incident. And China knows this. And China is also, in a way, they're kind of on the same page. Anytime the U.S. has cracked down on some of these older ships, China has actually endorsed or told their ports to also ban these ships. So this isn't like, there's not a whole lot of gap here between China, India, and the United States long term when it comes to environmental catastrophe mitigation. Like,
and
China
nobody
does not
likes
want,
it.
Yeah. We don't want another Exxon Valdez. Nobody wants that, and that could happen. And so, anyways, with these ships, we have about 32% of the fleet is over 15 years old. And so it's already past that tier 1 capacity, and 15% is over 20. And that 15% over 20 should not even be on the water. The only reason it's on the water is because of the sanctions and the dark fleet. And so we expect We don't know yet. It's too early to say for sure. But as I mentioned earlier in this interview, Trump's number one national security representative has talked about his primary objective is to pressure Russia. And he even mentioning targeting the trades directly, which means the tankers, targeting those dark fleet tankers. And so if you remove that 15% of the dark fleet tankers and your order book of ships is 4 for this year, right? Suddenly you're going to have a gap in tankers. And as I mentioned also, if this causes tanker rates to go from maybe 25,000, 30,000 a day to 80,000, 100,000 a day, that's only going to move the landed price of oil by $1 or $2. Okay. So it's not going to have any sort of massive impact at the pump or anything like that. You might be talking about 5 or 10 cents in gasoline. So it's not a significant pain factor like it would have been in 2022. I don't want to get into politics or anything, but people say, well, how could the Biden administration be so dumb? Or how could this sanction be so terrible? Well, it was a different reality in 2022. Oil was $100.
Right.
And inflation was raging. Well, now inflation is down to 3% and oil is reasonably affordable. And so we're in a position where these ships could be targeted. So with all that said, we've done a similar process like we did in dry bulk. We looked at the top listed companies, the ones with enough scale, the ones we trusted, and we looked at the valuation metrics. And one of the companies we like, it's not the only one, but one of the companies we like is International Seaways, INSW. And this company is a full up US company. So it's not a Greek company, it's a US company, a US headquartered, US listed. I've known the CEO and CFO there ever since the inception of the company, so about 7 years now. And they have had excellent capital allocation throughout the cycles. They have a very conservative balance sheet, no leverage issues there. Their fleet is modern enough that there shouldn't be any major demand for fleet renewal in the next 3 to 4 years. They've had a nice dividend policy. They pay out about 50% of their earnings as a dividend. They've done some share repurchases. They've done a little bit of strategic renewal of the fleet. They've added a few modern like LNG powered tankers and some of this more esoteric stuff. But we really like International Seaways, INSW. And it's a similar setup as the dry bulk market, but I think there might be a little bit more catalyst rich action in that name.
Wow, that's terrific. Listen, it's been great getting to know you. I'm going to give you a chance to tell people a bit about your shop in one sec, but I'm going to put you on the spot. I didn't actually tell you this, but often I end the show with something a little more personal, and I'm going to give you a choice. You can tell people something that someone did for you that was very kind in your career. You can share an anecdote like that. And I'm going to keep talking so you can think about the answer. Or you can share a new book, what I call the triple Bs, a new book, broadcast, or band that you had. And broadcast could be a podcast, a TV show, whatever, something that you want to talk about, something you're like, oh, I just got this TV show, it's terrific, or I'm listening to this podcast, that's a fantastic. So one of the two, you pick. Put you on the spot.
I like the surprise.
Okay.
This is not a pre-identified question, so everyone listening knows.
I forgot. It was more because I was like, I'm just behind this week, and so poor.
No.
Poor Jay gets a little bit more ad hocness.
No, I'm glad you didn't. It makes it more genuine. One of the names that comes to mind to answer the first part of your question is Ellie Hoffman. He was the CEO of Seeking Alpha, and Ellie Hoffman passed away about 4 years ago. Sadly, unfortunately, battle with cancer. But Ellie Hoffman, back in 2015, Seeking Alpha was starting to launch with, at the time, they called the Marketplace. And it was sort of like the precursor to Substack. You could launch a service on Seeking Alpha and sell your research and things like that. And at the time, I'd been writing blog articles and stuff on Seeking Alpha for, I don't know, 4 or 5 years at the time. But I had, not a huge following. I think I had like maybe 3,000 or 4,000 followers on Seeking Alpha, something like that. And he reached out to me and sent me an email, and he said, hey, Jay, I know you're a little bit younger. You're a little bit newer to Seeking Alpha, but we've been looking at your engagement metrics on your articles and the amount of comments that you get on your articles, the respond rate that you have, the cohesion. Like your 3,000 followers is not a lot, but every time you put out an article, you have like 90% of your followers read your articles. He's like, I think you would be one of the perfect candidates to launch a service on this brand new platform, Seeking Alpha. And that's what enabled the launch of Value Investor's Edge back in 2015.
Oh,
and,
wow.
And I never dreamed, at the time I thought, this will be just part of my hobby. It'll supplement things. It'll allow me to develop a nice little community. We can focus on deep value and shipping and things like that. And, I never dreamed that at this point in time, what a life-changing event this would be, that would enable us to grow to a team of 8 analysts, membership of over 800 people. We are the number 2 in terms of annual revenue at Seeking Alpha, and they have 160 of these research platforms, and we're number 2. And so that none of that would have been possible without the belief and faith that LD Hoffman placed in us. And that's probably the single most life-changing thing in my career anyone's ever done.
That's a great story. I'm glad I asked you that. Do you have a band or a broadcaster or a book, or you wanted to skip that?
I think if since we're talking about shipping, and if folks want to learn a little bit more about shipping, if you want to start on the fun route, I like the light reads,
Okay.
The 2 books I would recommend are The Shipping Man by Matthew McCleary. You can get that on Amazon paperback, $7 or something. That is such a fun, entertaining read that will just get you into the industry of shipping. You'll learn about all the little backroom deals and crazy things that happen in shipping. I very much recommend that one. The other one is called Box, BOX, and it talks about the growth of containerization and how that was invented. It's an amazing American entrepreneurship story. We are getting we are getting crushed by China and Asia and all this kind of stuff. But all of this containerization trade was invented and originated in the United States. It was a retired truck driver that invented this whole thing. And it's just a fantastic quick read. So The Box and The Shipping Man.
That's
hopefully you'll read those 2 and you'll become as passionate about shipping as I am.
All right. So why don't you tell people about your shop and where they can find out more?
Absolutely. So the easiest way to find me is on X, used to be called Twitter, at Mintzmyer. So you'll see the name in the podcast there. You can follow me there for free. I don't tweet a whole lot, but probably 5 or 10 times a week or so, and you can see links to all our products. So that's the easiest way. Our research is available at VIE, like Value Investors Edge, VIEresearch.com, and that'll take you straight to our landing page. Our service is meant for, serious investors and traders in the sector, so it is priced proportionally to that. But we do have a 1-month trial offer where for just 10% of our platform costs, so for $4.99, you can try out our entire platform for 1 month. You can see our analytics, you can see our reports, you can talk to the team in our live chat, and you can see if this is the good fit for you. And so we do that to allow folks to get into the door, look around, see all of our historical reports and say, hey, is this going to help me in my investing and trading? So www.vieresearch.com will take you straight there. And if you just want to follow me for free and see some of the tweets and things like that, just at Mintzmyer at Twitter.
That's terrific. Jay, it's been a real pleasure getting to know you. And I love your success story and you just made me smile the whole time through. So thank you very much for taking the time to share with us all.
Absolutely. Thanks for having me on your show, Kevin. I really appreciate it.
All right, Patrick, lots happened. It's been a long time since we've done this.
Absolutely. It's been the New Year's or the Christmas special that we did. So there's a lot to catch up on.
It's almost a month.
Yeah, it's been a month pretty much. Yeah. And so let's jump in quick and just not review because we'll just talk about what are we going to watch now, because here we are. It's the OPEX for the January expiration. This is when all the huge single stock futures like leap positionings and everything are rolling off the books. So it's interesting that we're have obviously Martin Luther Day, a shortened week next week, and the Trump inauguration. So lots to talk about. Let's talk about the top 3 things to watch. And then let's get the charts up and really kind of discuss what's happening. So first off, I wanted number 3, just to ask the question, was this a breakout or a fake out for crude oil? Right. And we'll just quickly pull up here a chart of crude, but we basically had a crude oil market that was in this nasty, 7-8 month decline. And down along the lows, pretty much everyone was bearish. Everyone was short.
It was so one-sided, and the pessimism was overflowing,
right? And it was to the point that I went long just as a fade.
Well done, buddy.
But this only because short squeezes happen when everyone's in consensus and positioned one way. Inevitably the market just simply has a liquidity event kind of flows thing that shifts the market. So we had this squeeze. Now let's put it in context, Kev. If you look at the last 3 or 2 or 3 squeezes oil had on the upside. Let's say back in June, it had a $12 rise in 29 days, right? Then it had back here in August, it had this little $9 $8-9 run, which is 11-12% over a week. And then it had this squeeze back in October, where from a trough to peak, it also went about $12 in about 8 trading sessions. And so these squeezes happen, right? They just counter trend moves that rip. Well, this oil move right now has been a $12 rise in about 25 days. Okay. So the point is that this is consistent with prior little short squeeze rips that we have seen. And that's why it's, in my opinion, the top 3 is this a trend shift? Is this the beginning of a new bull phase for oil? Or was this just a short squeeze liquidity thing that happened that was a rip that we've seen numerous times last year? And will it fade right back to lows and just go back into its trade range? And so is it a fake out, or is it the beginning of a bull phase? What's your opinion?
I don't know. I have no clue. And if I was, if I could tell you that, I probably wouldn't be sitting here chatting with you. I'd be out trading it. I just don't know. I think it's a great question. I think it's a great highlight as well that you point that we do this all the time in crude. Barring anything new, you have to say that it's just another one of these $10 to $12, rips higher. And now we just go back to grinding around and we're back in the range.
So what I always say technically to my members is that the rip is not the story. The story is the subsequent dip that happens after the rip, which is if it's entered a new bull phase, then as there are corrections, let's say oil goes from 78 back to 75 or $74 or something, then we should see buy on dip traders quickly scoop it up and bring it right back up. You start seeing accumulation, that dips are being bought and generally new price levels are being found for crude oil. When those characteristics are exhibited in the weeks to come, that's where the big tell comes, right? The one thing that would be devastating for anyone that's holding the bull case is this thing to fade entirely and we're back down to $70 in a week or two. If we saw that kind of a drop, then that's definitely a fake out that is leaving oil dead in the water for another couple months.
Hey, by the way, I know how we can tell if it's a fade or not.
Tell me.
Are you guys back to talking about crude oil on your other show?
No. Okay. So, let's go number 2. All right. Number 2, over the next 2 weeks, we have Bank of Japan, ECB, and FOMC, Bank of Canada. There are a whole bunch of monetary policy statements coming out. And the interesting thing for me will there be a material divergence from what the Fed says because of U.S. conditions versus what the other central banks are going to be doing? And will that divergent monetary policy, has it been priced in, or will we see prevailing trends of like strong U.S. dollar and other things like this persist and continue? What are your thoughts?
Well, so first of all, I think it's not just the Fed that is getting more hawkish. We have the Bank of Japan. It's largely priced in that they're going to raise rates as well. And then one of the real issues, Patrick, is that we're going to talk about this in the number 1 thing to watch next week, but how much changes, come post Jan 20.
Yeah.
And a lot of these decisions by the central banks won't, let's just put it this way, they could be not as consequential as they usually are, because we could find ourselves in 2-3 months with much different macroeconomic backdrops.
Well, that's the interesting part, which is, let's actually just put number 1 up there, which is the Trump inauguration.
Right. Like,
just think that way we can talk about it. We can talk about it all as one
right,
big story.
Because think about Bank of Canada, for example. So do you want to go make a big stand here right in front of Trump with the tariffs? Or do you want to wait and see what happens? And it will be post Trump and the tariffs. So we don't know. So here we are sitting around trying to decide. And the reality is that Jan 20 could be a huge deal. And I personally think that the market is still overly optimistic about how friendly all of his, 100, executive orders that he's got ready to sign, how market friendly those are going to be.
Yeah.
So I think a lot could change come Monday, and it'll be interesting to see how the central banks react to it.
Well, and that's to your case, which is that will the central banks all basically take their foot off the either pedal or brake and just say, listen, we got to go into a short-term holding pattern to buy ourselves enough time to see what are the knock-on effects of these changes before, because the last thing a central bank wants to do is look like they're flip-flopping. And
Exactly.
and so the thing is, then in order for them to take a stance that they can be consistent on, they need to have a better and clearer understanding of the future landscape. And then clearly, that's not so easy to understand right now.
Yeah, and that's why I think there won't be any bold decisions made from the central bankers.
You're right.
They'll be trying to stall for time as they understand how this is developing. That doesn't mean they don't cut or they don't raise. They just do it. I just think that this won't be the time to be looking for something abnormal to happen.
Yeah, I agree. So let's talk charts and let's talk about the markets here. The first thing that I want to start the entire talking charts segment with is this idea that obviously there's some very clear prevailing trends in the macro space. Maybe the stock markets themselves have been in a muddle for the last month, but the dollar and interest rates have 100% been in a very clean and distinct trend. And this trend is backed by this idea that the impacts of Trump's administration are clearly known. And one of the things that I kind of ask myself when I'm in the situation is like, what is the market missing? What are they not getting? Because rarely does the market deliver consensus view. More often than not, consensus ends up being wrong, or at least something different ends up happening than at what everyone believed. It doesn't have to always be the opposite, but it rarely plays out exactly like everyone planned. And so we have a scenario where, for instance, the dollar, it's clear that a strong dollar has been evident because of the incoming administration, like the tariffs, all these different elements, that somehow a strong dollar regime will come in. But after seeing a move of this magnitude, and which could persist for months more, I'm not trying to be like saying that this is the inflection point of a reversal of the trend, but is the dollar, for instance, going to remain fundamentally bullish for the remainder of the entire year? Or is this going to be a scenario where once the initial things are fully priced in, that the dollar move on the upside may actually fade and shock everyone with a weak dollar during the second half of the year? And this is right now, technically, I have nothing to say other than a prevailing bull market, because there's nothing technically here that is saying that this is the reversal point. But I'm just asking myself, how sustainable is the dollar rally, and how far will it go? Are you what's your position on currencies here?
Oh, I think that the dollar's headed lower. But I'll tell you, I was in New York and I was talking to a lot of people on Wall Street, and the overwhelming consensus, and Patrick, overwhelming is not expressing the magnitude of the unanimity. I can't even say that.
Yeah.
Of
unanimous.
Of the opinions, because everybody was saying you have to own U.S. assets. You have to own the U.S. dollar. There is no way any other asset outperforms. It's this, new Trump economic boom. Everyone else is making a mess. Therefore, you have to own it. And there's just anecdote after anecdote of how bullish everyone is. And to me, it feels like I don't know who else is left to buy, Patrick. And I saw Brent Donnelly, terrific guy who we've had on the show, FX Spectra, I think is the name of his firm. He had a terrific blog post over last weekend where he surveyed everyone and asked about their opinions about Trump and about the tariffs, and then asked their positions. And I can't remember the exact figure, but I think it was like 15% were short the US dollar. It was like nothing. It's
Well,
nothing.
you can't really be short the dollar into a rip though, and so like the dollar short positioning will happen when the trend starts to shift. But
But in terms of the number of longs, like everyone's full on long.
so
Anyway, so I just think,
but here's my thought, and I'll let you continue. But I just while I in principle agree with you that there will at some point be a dollar downturn, and to be honest, I actually think Trump wants the dollar down.
well, 100%. I was about to say that, like from a fundamental point of view, if you're trying to put mid-America back to work, how do you do that with the strong U.S. dollar?
can't.
No. Like,
But you hear over and over all the people he's putting into his administration, right? Like these people are talking about, just diversifying supply chains, doing all these different things. You can't make that all happen when your dollar's ripping to the upside to that magnitude. Like it's just at some point the dollar is going to become the big problem for Trump, and they're going to have to do something to prevent it from just going full on parabolic.
Yeah,
it's
Patrick. I encourage everyone to go back and read the Bloomberg Business Week article that Trump, not one of his advisors, that Trump gave, and read what he said about the value of the yen, the value of the yuan. He said time and time again, these things have to be higher, that they are stealing growth by having such a low currency. So you can argue that Trump doesn't have the power to change the price of the dollar. It's a long, complicated argument. Maybe he doesn't. But the reality is that Trump will, at the very least, be pushing back against this shortly. And everyone says, oh, but he wants to have the reserve currency. The reserve currency doesn't mean that you have the strongest currency. It means it's the currency that everyone transacts in. Completely and utterly two different things that people conflate too often.
No, you know what? I'm with you. But you're asking the right question is that can Trump actually get his way and not have the dollar strengthen? And the interesting part of that is I would say that if he can't weaken the US dollar, then anyone who's buying the thesis that he's about to run a huge bull market and that things are going to be amazing under him because of all of his policies, well, his policies in many ways are going to be muted by the fact that the dollar's ripping higher. Like, in other words, you can't be betting that he won't be able to beat the dollar, and at the same time the stock that the U.S. will have huge benefits from his policies.
Well, I think that you have to be careful there, Patrick, because again, people confuse the economy with the stock market. And I think you could have actually a rip-roaring stock market with the dollar continuing to rise. It's occurred for the last year or whatever. And we see that it's happened specifically since October.
Right.
Stock markets rallied along with the dollar. So I don't think that that's quite true, that you can't have a rip-roaring bull market in the stock market with the rip-roaring rally in the dollar. I think you can, but I don't think you can have an improvement in the economy, especially the mid-America economy, the people that elected Trump, with a rip-roaring dollar rally.
Right. So I have a quick peek here on the weekly chart, and you can see the dollar index obviously in 2022 hit a high up around 114, 115. Now, I'm not in any way bearish the dollar. In fact, I'm actually outright long the dollar currently. All I'm doing is asking the question, when is the time to kind of neutralize or hedge my positions and or even take positions the other way? On the short term, can the dollar rip another 5% and make it all the way back to its previous highs as the euro temporarily redips below parity? These are all short-term moves that still actually can happen. But the bigger picture is the one that we're debating here. Is when will that bigger picture shift in trend occur? And so on the short term, a room up to go back up to those previous highs is on the table. And I'm not taking positions the other way just yet, but it's one of those things that you have to watch this closely, because there's going to be a point where all the US dollar bulls are going to have the rug pulled out from under them. And the question is, what will be the trigger, and how long do we have to wait for something like that to play out?
And Patrick, to your point about the fact that we've had this rip roaring rally and that we could continue to rally, you're spot on. And I think back to the Jimmy Rogers story that he always tells. He says that when gold was rising from, what was it, $250 or $200 to $800, that big rally in the late 1970s, early 80s, he said, I sold short gold three days before the top. And he says the trouble was it was also $250 or $300 too early.
Yeah.
Meaning that the parabolic point of it was at the end. And this is what you often find, is that as a trend continues and gets to that point where maximum euphoria kicks in, the rises end up being exponentially more volatile. And then the decline ends up being the other way.
Right.
So I'm not discounting the fact that maybe we do get this absolute, just complete rip higher on the dollar that causes tons of pain in the U.S. economy and just throws the whole world for a loop. And that will be the point where you sell it.
Yeah, no, there's going to be that point. And right now there's no technical evidence that it's here right now today. So we're just having that debate as to inevitably what will happen. Another thing that was in a huge trend and continues to be is interest rates. So this is the 10-year yield, which ripped almost back to 5%, 4.80 on the upside. But I still am not, like, a lot of people are still anchored off the bear market of 2022, when the conditions were extraordinarily different. We were at the beginning of a rate hike cycle, going from and had one of the most historical rate hike cycles since Volcker. And at the same time, we had inflation that was in many ways driven by monetary drivers, expansions of money supply, all sorts of different things, reactions to COVID, all sorts of things that were underpinning that. And it squeezed the bond investors into what was one of the most historic bond bear markets that we've seen. And you were dead right about it. And kudos to you on that. But when you look at the underpinning conditions of where we are today, this is not doesn't have an underpinning condition in the macro space that should have bonds collapse. And you can like, oh yeah, but governments are running historically big deficits and all these other types of shit that you want to argue. But overall, you don't have a situation where inflation is going to run away here. It's not. So in my opinion, these interest rates are approaching the high end of the year. I think that we're going to see a substantial counter trend move, not a new bull market that's going to have interest rates go back to 2% or something. But can we go back to 2024 lows of interest rates? I totally think we can.
2024 lows. What are those?
3.5
on tens.
Yeah.
Oh yeah.
We were there just.
You're high.
What do you mean? We were there 4 months ago.
I know 4 months ago, everyone thought the economy was going to collapse. Although I shouldn't quite say that. A couple of things. First of all, you say that people are hinging their views based upon 2022 or whatever it was. I would argue that some other people are hinging their views on the post-GFC, pre-COVID environment of abnormally low rates. And they're weighting those much, much too high. And what I would suggest to the people that are like bullish bonds and talking about, going back down to 2-3% is take out the post-COVID period, take out after 2009 and just put it back in 2022. and then look at what rates have done, longer term rates. And the reality is that these are absolutely normal interest rates.
Yeah.
And that's the part that just I kind of cracks me up.
Okay,
they're absolutely normal.
Look at this chart, right? So this was the bond bear market, right?
Yeah.
And what I was just simply saying is that interest rates will come back to these levels where they were over the last couple of years.
Maybe.
Like come on, is it like is this?
No, it's not a bad argument. Trouble is that you people of your ilk have been saying that every single dip in the bonds are buying opportunities. They're almost as bad as idiots like me that keep shorting US dollars all the way up. And I just think that Patrick, and listen, from a short-term tactical trading point of view, I'm not there yet, but I'm really close, Patrick. People are lecturing me about term premium again. When people start telling me about term premium and saying that I don't understand it, that's my signal. So I'm just waiting for the one big lecture, and then I'm going to be like, okay, that's it. I'm in. And one of the things that worries me is that I kind of could see a spike. And the one thing about bonds is that you often want to fade the kind of mass moves. And so if we got a situation where all of a sudden we spiked 50 basis points quickly, I'd be with you. But I wanted to talk about one thing that I think is interesting.
Okay.
And it's kind of like a weird dichotomy. Increasingly, people are arguing that the bond market has had this 100 basis points of widening, of increased in yield at the 10-year rate because the Fed was too easy. The Fed did 100 basis points of loosening, and the 10-year went 100 basis points of widening. Now, this is what I've argued for a long time, and I think I probably did it on the show, but I definitely wrote this, is that an easy Fed is the worst thing you want from a long bond investor's point of view. And the people that are really thinking this through are saying that this move at the long end has resulted in a steepening of the yield curve and the bond market telling the Fed that it's too loose.
Right.
But the part about that that's kind of interesting that I can't really square is the same time we've had a rally in the US dollar.
Mm-hmm.
So you would say, well, short rates are declining, so therefore they're making the US dollar less attractive. Yet we're having this rally in the US dollar. Now, I happen to think it was a huge move. It was basically what occurred was the Fed was too easy too quickly. Bond market said no bueno, the yield curve, widened, long end sold off. And the reason that the US dollar is bid is because people are attracted to the growth in the US.
How much of a factor, though, do you think it is the fact that all the other central banks are also cutting? I mean, it's all relative interest rates, and so if the Fed is cutting, but Canada and Europe, and
but Japan's raising.
But okay, you're going to pick up a couple basis points there. Like
no, but what I'm just, it's just interesting to think about in that it's the fact is that some people are now arguing that this is the direct result of the Fed being too easy. And this is something I've argued for a long time, Patrick. Like I've probably done it on the show, and I've definitely, as I said, I've definitely written about it, is that the long bond investor wants an actually tight Fed. They don't want an easy Fed.
Okay.
And this is the pushback. And so I happen to think that you're probably not as wrong as usual about bonds. Because I'll tell you this. Let's just think back a year or two ago. We had this situation where everyone was convinced that we were going to have a recession. Like everyone, Patrick, like there was that. I have a graph that I include that's I think it's the St. Louis Fed goes and shows the percent of forecasters that think there's going to be a recession in the next year. And they have data back to 1968. And 2 years ago or a year ago, it hit an all-time high, meaning forecasters were never more sure. And it wasn't just like it ticked a little bit. It was like off the charts way higher.
Right.
So it was like everyone was completely convinced we were going to have a recession. You'd go around, you start talking about the effects of fiscal, and you start saying that maybe things aren't as bad, and maybe there's going to be a little bit of a lift here with this. And you got told you didn't understand what was going on, and you didn't understand the economy. Now, fast forward to today, no one thinks there's going to be a recession. No one. And all I'm saying is, well, okay. And I think that one of the problems with many people in the finance industry is they talk about forecasts without talking about the price of making that bet. It's like going and saying like your favorite team's going to win the Super Bowl, and that's great. Whoever is the betting favorite probably will win the Super Bowl. But really, we as investors are more interested in, do they meet the spread? So is it a good bet?
Yeah.
And I think that people don't put those two together enough. They're just focused on making the call. And yes, I completely see that there is a very little chance of a recession over the short run. I don't see where it's going to come from. U.S. economy is doing great. Everything seems to be fine. All I'm saying now is, in the past, everyone was betting on a recession, never came. Now I could make an argument for a variety of different reasons that bet is much, much more attractive, and that we could have a recession.
Do you believe that it is enough for simply the wealth effect to turn the cycle down? Because right now, obviously, the Mag 7s went through an amazing bull run, and the indices are at highs. And because the average American does have some degree of exposure into the markets, when they feel wealthier, when they have more equity, when they've making more returns, they tend to spend more. It's like a natural thing. And I think the stock markets and the wealth effect of everything rising has been a contributor to why we haven't fallen into a recession. Everyone feels good about things right now. The question is that if we went through a deep reversion of the Mag 7s, they went and started a bigger correction, and it caused some sort of a market pullback. Could that alone be enough to have people tighten belts, stop spending, and be enough to start turning things down?
I think so, but I don't view that as the driving factor. Now, having said that, I don't think Cuppy would mind me telling you that Cuppy very much believes in that. And that is one of his things. He says that people, when the economy turns lower, that they spend less. And that's when the stock market turns lower, they spend less. And that stock market returns are driving the economy. I might push back a little and say that it's back to my idea about deficits. Government deficits are the private sector's credit. And so if we have a situation where they stop spending, we could have less private sector credit. And I feel like the stock market is more reflective of the liquidity and the underlying economy fundamentals than it is actually causing the underlying economic fundamentals, if you understand what I'm saying.
Yeah.
Like, we're arguing about which one is driving the other. And I'm not going to disagree, though, that it's reflexive in that as it goes higher, people feel stronger about, their outcomes, and they believe that everything's great, so they spend more. And I think that's what we're experiencing right now. Like, everyone, has Trump really changed anything? Nothing yet. And I might argue that some of his policies will actually be bad for the stock market, but nobody cares. Okay, and it's just, yeah.
So let's talk about that. I want to throw an idea at you and just get your brain, pick your brain in terms of how the impact is. So to kind of, in a very high level way of summarizing the approach, is that they basically want to cut a whole bunch of government spending with Doge.
Yep.
And pass it on to the consumer through tax cuts. And so to me, though, there's a material lag time between this. There's an air pocket, because I feel that, okay, when they start cutting, immediately a certain amount of the government spending that you talk about is immediately almost withdrawn from the system. But a tax cut may not be felt for a year until the next year's tax cycle. Like ultimately, everyone's already going to be filing their taxes in the next few months. It's already based upon rates that were in there from the previous administration.
I'll go even further though, Patrick, and sorry to interrupt, but I just want to interrupt here because I think the tax cut, they're going to use the Doge just to fund the tax cut that was coming off that they feel needs to be funded.
Yeah.
So to your point, I don't even know if there is a tax cut. There's just no tax hike, if you understand. Because Don't forget, we had the Trump, whatever it was, I can't remember his tax cuts, and they were scheduled to come off at this point. And when they come off, like if nothing happens, taxes go back up in the States.
Okay, so let's pretend for a moment though that there is an actual tax cut. Let's just you might be right, but let's just in this storyline say that there is actually going to be a benefit to the end user.
Okay, so they go even further.
They go further, and there's a benefit for all of this.
Okay,
but there's an air pocket in between. But if that government spending is immediately being attacked and pulled out of the system, that in itself is going to slow the economy.
I'm with you.
And now, the thing is that the benefit of the tax cut is something that's actually felt farther down. So what happens in that pocket of time between?
Yeah. So I will give you their argument. I'm with you. I happen to agree with you, but I will give you the Bulls argument. And it's also those who believe in monetary policy over fiscal policy. So they would say that once you cut taxes and once you stop spending, that opens the way for private sector to go and take that place, stops crowding out the spending, and therefore you get economic private sector revival.
100%, but the question is the lag time. That right there is time. But I'm saying that's a 2026 story.
But they would say that maybe we'd get your long rate back to 3.5, and that'll do it.
And this is actually another point. Is like if you let's say look at what the U.S. mortgage rates are based off of. They're based off of longer term interest rates. They're fixed rate mortgages. What do you mean? No.
No, I agree with you. I didn't mean to. It just instinctively comes out of my mouth. But
if you turn around and if I'm not right about the bonds ripping back to the 2024 levels, the yields going to levels and bonds going back to those highs, then those interest rates are not going to allow an easy revival of the U.S. real estate market. They're going to be, I wouldn't say they're a massive headwind, but they're not a tailwind.
Yeah.
And so there's a lot of these knock-on things. Like I honestly think Trump needs low interest rates and a weaker dollar. And the question is, are they going to put in place things that lead to that?
So I agree with you that those are the two things that Trump wants. And I don't know the time frame for him getting them. I think eventually he will pressure the Fed to lower it, and we will have an extremely steep yield curve. The other thing, though, that Patrick, in terms of what the Bulls might say, and on this topic, I completely agree. Private sector credit creation has been definitely hampered by excessive regulation in the banking sector. There is no doubt about it. They have just gone, and after the great financial crisis, they clamped down on these guys. They put way too many restrictions. They made it so you can't create credit as easily in a bank. And it's just been one regulation after another, and it is ridiculous. And all we have to do is remember back when Ben Bernanke couldn't renew his mortgage. He didn't qualify. Like, it shows you how stupid it was. They went and they bolted the barn door after the horse had left, right? Typical regulators. And now Trump is talking about going and unshackling the banks. Mm-hmm. And if that is the case, you could see private sector credit creation way more quickly than we have ever seen it in the past. Now, I am sympathetic to that. And I actually
they still though need a creditworthy lender or a borrower. Like they can go and do all this credit creation, but ultimately, if the consumer is tapped and businesses
but the consumer isn't tapped in the States. They're at 70%. Like, if you want to argue this for Canada, I'm with you. Canada's screwed. We have way too much debt. But in the States,
but at the higher interest rates, your loan ratios are higher.
The consumer in the States has more room than they've had in ages. There is room for them to relever the consumer. So, okay. But I'm with you. I'm with you in terms of timing. I completely agree with you. Yeah. And then the other thing is, we're talking about it, is that this stock market is priced at 22.5 times next year's earnings. You're not buying a cheap stock market. And all of these things, everything needs to go perfectly for you to continue making money. And we haven't even talked about the chance that this AI shit ends up being a bubble, and that, maybe it changes the world. But the reality is that the stock market's gotten way ahead of itself.
Let's talk the stock market in the bubble, because I think we've made it very clear, like, we're on these interest rates in dollars. So let's talk equities. Now, first of all, there was one I want to just at a high level, because I want to talk about NVIDIA and all of these other AI stories. But let's start at a higher level. The S&P 500 is almost back up to its highs, and the correction has been very modest by any means. Like even the July market event that we had in the summer was much larger in magnitude and even velocity than what we have seen here. So the market's been calm, but the Mag 7s have hidden this, because when we look at that equal weight S&P, we had a 1 month market correction that has been very deep reverting. And in fact, if you looked outside the Mag 7s, there was some very ugly price action and charts that were there. And to reflect that was the extremely oversold breadth of the market, which, like, if we got so low on the breadth reading of this, in this case is the number of stocks above their 50-day moving averages, that it was the same levels as the June and October lows of 2022 and the October low of 2023. We were so oversold on this metric that we were literally, with the S&P above its 50-day moving average, down in the teens on this metric. And so you have this part of the underpinning market that was grossly oversold, and the Mag 7s holding up along their highs, that basically, because of the market cap weighting of the index, made it all look like everything was fine.
Unbelievable, wasn't it? Like, I think it was record. Like, we've never experienced that. Jason Goford, I don't know how to say his last name, but from Sentiment Trader, he had some great charts that showed this kind of weird paradox in terms of like how strong the stock market was versus how weak the rest of the broad market was. Yeah, off the charts.
And so we had this really oversold part of the market that was ready for a bounce. It was ready to go the other way, and so there was only two outcomes. Either A, the Mag 7s were going to have the feet kicked out from it, and they would have exacerbated a big kind of liquidity event crash on the downside, or if the Mag 7s didn't crash, then these were so oversold that when, for instance, the banks broke out on their earnings over the last couple of days and all these other types of triggers happen, suddenly we're getting a relief rally, not in the Mag 7s, but the relief rally in the beaten down stocks, right? Like, and this is the more interesting element. Is this a sustainable S&P rally? Like, if, like, I'm just going to pick on a stock like, let's say ExxonMobil, but like, if this was just an oversold bounce and this thing is going to, come to a 50% retracement of its prior decline, and was just so pent up, like someone jumping off a bridge with a bungee cord tied to their feet. It's just like it stretched too far. And now we're seeing that snap back in these. But if the Mag 7s don't join the party, and these just get from an oversold state to now just having, short squeezed bounced back to the upside, or is this a condition for the market to be bullish, or is that just the next bear setup? for another short lower?
I don't know, man. You're the technician.
Well, I think there's a lot of things that have to be the puzzle. Let's talk about the puzzle pieces. Number one, let's talk about NVIDIA. And so here's NVIDIA. Look at how much NVIDIA has participated in this rally in the last week.
SFA.
Yeah. It literally hasn't moved. How much has, let's say, Apple participated in the rally over the last couple days?
Oh,
right?
And that's a 6 stock. Like, listen, put your technician hat on. Don't forget about everything else. Tell me what you think about Apple.
Apple, it broke below its fib zone. If it was a healthy market, it should have been bought on dip at its 50-day moving average. And the fact that it has not is showing there's clear distribution happening in the stock. Now, I wouldn't short it at this price because it's going to bounce at some point, but this is a trend break. This is a stock that is no longer bull trending. The point here is that when you take a look at the mag stocks, they really haven't moved much. Now, they didn't really break down, but they're not the ones rallying here. And so we're in a situation where if the mag 7s don't join this party, then as soon as we get this very oversold part of the market getting kind of bouncing back here, then we're going to see potentially all of this roll back down. I think the Mag 7s have to rip in order for this to be another full bull leg. Like if we're talking S&P going to 64, 6,500, the Mag 7s have to break out, and they're not as of this moment. And that to me is a warning sign that you can't trust this rally. And now that doesn't mean the rally won't double top retest its high on the S&P. It doesn't mean it won't create the head of a head and shoulders pattern. Like it could be a head and shoulders kind of topping formation that basically ends up disappointing everyone by being a big topping formation for the first quarter of the year. Like there could be different things that still happen, but the question is there upside on the S&P? In my opinion, unless the Mag 7s join the party, the S&P is just going to be topping. And that's my market call on that.
I like it.
Okay.
I have no comments really.
All right.
The only thing I will say is that to me, it felt like the year end was a mad rush into Mag 7 as people were underweight and as foreigners rushed in to buy the asset that had performed the best. And I still think there's a good chance that was the top in the relative performance of the Mag 7 and of America versus the rest of the world. And like I saw on Bloomberg this morning, I was watching it. European stocks are higher than the S&P this year.
I want to talk about that in a second.
Go ahead.
We'll get to that in a moment.
Okay.
Actually, you know what? Well, let's do that because I was going to move on to commodities, but let's just quickly touch on the other. First of all, the Nikkei has been grinding it, right? So Nikkei, it's not that I don't think it's outright bearish, but it's not been participating. It's been basically a meat grinder trade range in there. But what's been shocking is that the Euro stock ripped to a fresh high after spending virtually the entire year in one monstrous grind. Then while the S&P and the Mag 7s ripped, suddenly Europe is taking flow. Yeah. Now, obviously, a weak currency is a tailwind. And the question I have for you is, how much do you think the weak currency has contributed to this? Do you think it's that big of a deal, or? No. Usually, when a currency gets cheap, that you can buy these stocks much cheaper, right? Like, and so I think that it is certainly positive, not a negative, to the movement of this indice. But the fact that this managed to break out to a fresh new high is certainly attention worthy. It's like, is this the beginning of another bull leg?
Well, the other thing is, Patrick, I've always argued with people that tell me, why would you buy European stocks? Like, what would, like, they suck. Why would you buy them? Why would you buy the European currency or whatever currency you want to do? And I always say that when the move out of the US occurs, because everyone is so overweight, it doesn't need to be that they're going somewhere else that they view as better. It's just marginally less bad. And it could just be a situation where they're going back to benchmark.
Yep, back to benchmark is all.
And that's what, and I've argued this for a long, long time. Nobody seems to agree. They go, well, look at it, it stinks. And I go, well, the reality is that everyone is underweight European stocks. So all you need is someone to go, hey, instead of being, 500 basis points underweight European stocks, I think I'm only going to be 250. And that move causes the European stocks to go up. And I think it's as simple as a reweighting at year end, like in terms of new people looking at it, big long-term money readjusting.
100%. And one of the key elements of when people decide whether to be overweight or underweight a space often has technically driven trigger points. In other words, with the Euro stock breaking to an all-time new high, that alone could be enough of a trigger to get people from being underweight to equal weight the Euro stock, because people chase performance. Yep. And when a market is working, then they don't want to be underweight that space. They don't have to be overweight it, but the fact that this is breaking out this way could alone be the feedback mechanism that actually causes this to continue and to persist. It's and when the Euro stock rips, just remember what happened in 2023. Like this thing, when it broke out to a fresh high, this thing just would not stop. It was relentless. That advance. I'm not saying that has to repeat itself, but like these things can take a life of their own.
It would be hilarious if it ends up being the European stocks end up
outperforming the US.
Yeah,
wouldn't that be funny?
Be the market that everyone ends up chasing.
Well, but you know what? It's important to sometimes be a contrarian that way, right? Like, being in consensus is always challenging because then you have to always be ahead of the herd. Yeah. Because otherwise you get trampled.
Well, I hate, like, this is what scares me, Patrick, about like the bonds.
Yeah.
I was on this panel at StoneX, and I'm sitting there and everyone had all sorts of different opinions and we're going back and forth. The only thing everyone agreed on was that bonds were headed lower. I felt like covering my short right there and then, and I probably should have. That probably was the low in the bond market.
So come join the dark side and go
dark side. Yeah. No, that's not going to happen. But it's just that
that's not going to happen.
I only go long bonds when someone lectures me about term premium. I have to wait for the lecture.
Let me tell you about the term premium here.
But
let me explain to you.
Yeah, you're going to explain to me why it should be zero or negative, though. That's the problem with you.
Okay. So let's talk some commodities. And I want to start off by just talking about gold. And gold reached a kind of peak euphoria back in October when everybody was so sure that it was going to go up to infinity and beyond. And there was not a bear to be found. And at that time, I was just like, come on, exactly to the way that people are about bonds today and the dollar today. It was just too consensus. And typically what happens is a market takes a break. And in the case, gold has now been in a 2-3 month period where it's just consolidating. And it's very reminiscent of what happened in April, May, and June of last year in the summer, which was just after a bull run, it consolidated sideways for an extended period of time. And then eventually the bull market continued. And so the puzzle to solve here is that has this been sufficient of a consolidation that has lasted long enough? And this in this case fits the geometric shape of a horizontal triangle pattern in technical analysis. But has this consolidation played its course? And are we witnessing the potential resumption in the gold bull trend? And that's an interesting thing to solve. And it won't take too long to find out because we're literally trading along the December high. And if it is a support resistance trade range market as opposed to a new bull breakout, we should see gold hit resistance levels here if it's not a breakout. And so for me, watching whether the bulls can follow through these kind of resistance levels is going to be a big tell as to whether or not there's a resumption, because a breakout here in gold's going north of 3,000. No, so the puzzle is to solve, is it happening now? And so this is an interesting crossroad. Even like, look, when you look at where silver is, you can I will pull out a nice thick crayon for this one, but you can just draw a trend line along these highs. And, if silver stays above its 50-day moving average and breaks out of this trend line, and it confirms with a gold breakout, suddenly precious metals are back.
We're back, baby.
Now, have they broken out? No. This is simply us observing that this is when you have to freaking pay attention. This is the moment where we're going to get a tell as to whether or not this market has woken up and a new trend is going to begin, or whether we're going to go through a further 1 month consolidation. I still think it resolves itself bullishly. We're just trying to figure out whether it happens here in January.
So I'm going to give you my 2 cents on gold.
Yeah.
I keep people keep talking to me about the US dollar and interest rates. And I'm like, I feel like Michael Jordan in that video about drugs. Like, stop it. Get some help. That is not what's driving gold. Gold is getting driven by the People's Bank of China buying this thing just as a way to diversify outside the US. And I might even argue that part of the reason the gold is rallying over the last few days the last couple of weeks is that Chinese might be selling their bonds and buying gold. And when I think about like potentials of Trump, if we had a situation where tensions
heighten,
no, the other way, got better with China, I would actually be less bullish gold, because if Trump found a way to
I just kind of nearly choked on my beer here. You think things could get better between China and Trump?
Oh yeah,
as opposed to worse.
Oh yeah.
Did you not listen to Rubio?
But that doesn't matter.
This shit with China ain't freaking over, and Trump is not suddenly going to be buddy with them.
No, but
maybe with Kim Jong Il, but
it just could be that it beats expectations, even if they start talking about it. Now, I happen to agree with you that chances are it's going the other way, and that Trump's going to do some crazy stuff, and China is going to go, "Hey, you know what? You like that? Here's some 10s and some 30s to choke on," and they're going to sell their bonds. And if that's the case, I could see a situation where people go, "I can't buy gold because rates are going higher." I think you buy gold because China's selling their bonds and they're going to buy gold with some of it. And that's why I think that. So I think that the idea that you watch, be careful assuming that. Listen, I understand lower rates means Americans buy more gold. Like if you got a situation where all of a sudden they lowered rates, that's would buy more gold. But we're not the ones setting the price.
Yeah,
the people setting the price are the People's Bank of China, and they're going to buy more
a global
gold.
asset. And
well, not just that,
buyers outside the U.S.
But not just that, they're the ones. They're the biggest player by far. Yeah, like I keep saying this, you're playing poker against one big player. So think about what that player wants to do. Anyways, that's my 2 cents on gold.
Let's get your 2 cents on nat gas, because there's been a rip. Now, here's the continuous chart on the weeklies, just showing that we literally broke out of a 2-year trade range on nat gas. We're out of this kind of $2 to $3.50 pocket on the upside. But I like to look at the strip. So I'm going to just switch this to the UNL, which is the 12-month strip. And we're seeing nat gas wake up. This is most reflected on a bunch of nat gas equities, like whether EQT or Range Resources or a number of these names. There's been a huge bull run happening in a couple of these natural gas securities. And so the question here is this just us coming back to the kind of, in this example, back to 2024 levels on this ETF, or is this something that is now dynamically shifted where nat gas could actually be in a bull market?
Well, I will say, remember that meme you see on Jurassic Park with the chubby guy and he goes, "See, no one cares." Like when he's talking about it, he goes, that's how I feel with natural gas. Like nobody cares. Like, tell me the last time someone got excited about nat gas or talking.
Nobody. Only the people that have been making money on nat gas stocks that I deal with. Other than that, nobody gives a shit.
Yeah.
No one mentions it.
One of the things I will say is that if this is a change, it's so early that it doesn't.
No one's
like it's so early. But still, even with this great performance of these stocks, nobody cares. So, Contrarian me believes that chances are these things are headed a lot higher. And this is the start of something bigger.
Well, I don't want to buy the rip. I'm going to see whether there's dips to buy because, like, look at this. Let's say Range Resources or EQT or something. Like these stocks have made a huge move in the last 6 months already. Like I don't like to buy something that rips this thing's up $10 in basically a month, right? So I'm going to wait for some sort of a dip to buy, but. Many of these things have broken fresh new highs and just are running away, and not many people are noticing.
Yep, completely agree.
It's I'm not even going to mention uranium. It's just quiet. I'm not bearish uranium, but it's just nothing's happening in the space. What is interesting is some of the ag stories are starting to bottom. Like look at the way Nutrien, for instance, recovered off of its lows. Just one example of an ag stock. CF Industries more bullish, Mosaic maybe a little less bullish, but we're suddenly for the first time seeing little rips on the upside of these ags. And the interesting thing is these ag stocks have been in a 3-year bear market that has just devastated them. Like you go and look, like Nutrien has basically peaked in 2022 and has wiped out 60-70% of its value over a 3-year bear market. And this is like the first time it's trying to get out of a 1-year trade range. And so the question is, are the ag stocks finally waking up? And again, nobody cares. Nobody cares.
I will say that a little shout out to my buddy Paulo Macro. He's all over this. He's convinced that there's a bull market there. He's trading the grains. And I don't know if he's trading the stocks or not, but he's definitely trading the grains.
Well, corn's been ripping.
Yeah, I got to hear about it all the time with him. So
but soybean is basing, and wheat hasn't joined the party yet. Right. And so it'll be interesting. It'll be interesting to see whether they all turn up because it's when all the grains are running together that suddenly everyone's like, hey, we got to do something over here. Yeah. It's still a bit of a mixed grain market. It'll be interesting. By the way, copper, you think it could bottom? Like,
yeah, I'm bullish copper. I think it's one of those things that you should just.
Well, what's interesting is that okay. Technically, you can. I'm going to draw 2 crayon lines here. This one here, and then this one connecting these highs, right? And so we're at an actual interesting moment, right? The very short-term downtrend broke. And we're getting back about the 50-day, but we're now coming to the top of a potential breakout point. But if copper stops making lower lows, old dips are being bought, and it sets up like it's potentially ready to go, then maybe we might have a first quarter breakout. But what's interesting is no one seems to give a shit about the copper stocks. This is the COPEX. Like they have not even budged yet. The copper equities are not getting any reaction to the initial strengthening in copper.
Because it's back to what you talked about earlier with the move into Mag 7 and the fact that late in the year, everyone was buying Mag 7 and everyone was selling everything else.
Yeah.
All of these things have just gone thrown in, into that pile of saying like, why bother buying this when I can buy NVIDIA? It keeps growing. Everything's terrific. And to me, it's a huge opportunity. A lot of these stocks are dirt cheap. They're dirt cheap, like some of these things, the materials, and you should be looking at them. And the trouble is that it's tough while NVIDIA and Mag 7 and all these things have ripped so far, and you look like an idiot owning copper stocks.
Yeah. Yeah, that's it's interesting. All right, Kev, you know what? I think we've covered enough for the day here.
Okay.
Is there any last chart you wanted to bring
up?
Nah,
you know me. I don't have any charts.
No, all right.
I count on you. All right.
Well,
so thanks for tuning in, everybody. Patrick, where can they find more about you and your wonderful service?
Now you can follow me at bigpicturetrading.com or follow me on X at Patrick Ceresna. And Kev, where can they follow you, buddy?
They go check me out at themacrotourist.com. And listen, bear market, bull market, we're just glad you've come along for this ride. Now stick around for the after show. Okay, you're the only one drinking, right. Patrick.
Well, no, but listen, first of all, I start by messing up the start. I'm not going to use the F word, but but wrong date. Thank you, by the way, Kev, for
And that was
trapping
my
me.
fault. That was my fault. I wrote that.
But it's okay. You know, like I'm Ron Burgundy here, but I'll
I'm
just
Ron
read
Burgundy?
whatever. I'll read whatever's on the teleprompter. But funny thing was, I bought this beer just a couple hours ago, and so I put it in the freezer so that it's cold enough for me to drink. And then so I popped the thing open right at the start of the show, and I go to drink, and the fucking thing is frozen.
Oh gosh. So you actually didn't drink anything?
No. I drank it, but I had to like break the seal. So I'm like struggling here, like, oh, this is a great beer. And it's like it's freaking frozen.
I'll put that in the show notes just to make sure everybody goes back to the start to rewatch that.
There you go.
All right. So what do you give your beer?
You know what? It's an incredibly clean drinking beer, but I don't think there was anything special about it for me to give above average. So I'm going to give it like a 7.6. It was a nice, clean drinking European beer like you would expect. And I would drink it again easily, but I don't think it deserves any special score for going above average.
The company might argue that freezing it wasn't really the best way to do it.
I would imagine so. Like they definitely have something on that.
I mean,
I did drink it cold. I did drink it cold. That's
Okay.
Better than a warm beer.
I do just want to pick up on the point that 7.6 is average for you, which is...
Yeah, I only rate beers between 5 to 10, and only if it's awful do I go under 5. So 7.5 for me is
average.
Is average.
Okay, I got to tell you my story about this is funny. So I was at New York City, really great. By the way, we had a terrific / macro tours market huddle meetup in New York in the bar. It was terrific. Lots of people came. Everyone that came, thank you very much. Met one fellow Google engineer. I won't say his name in case he gets in trouble for this. He's teaching me all about things about AI and Canada's extraordinary contribution to this. Did you realize I knew that the godfather of AI was Canadian, but there's 3 godfathers and they're all Canadian and they're not all at the same place. They're like one's a McGill and stuff like that. I had no clue. But the funny part about this, so I was with the StoneX guys all for most of the week, and they were taking me around. It was a really big shout out to Mike. Thank you very much for the wonderful week. But one of the points that we had dinner, we're like downtown, we're like at 11th on the Lower East Side, and I'm staying at like 40th. And Patrick, the Ubers in New York are really expensive, so I'm a cheap bugger. I'm like, I'm not paying that, so I'm going to walk everywhere. And this was during their quote unquote cold spell, which they were bitching about it. But
yeah, you're a Canadian.
Yeah. So the long and short of it is we hit this bar. We're there. We're eating great stuff. Terrific evening. And then I'm like, I'm going to walk home. Anyone want to walk home with me? And Leonid Mironov from we've had on the show from Picat, he was there. He's like, I'll walk with you. And then our buddy Vincent Deloitte, terrific guy, by the way, had a terrific time meeting him in person and chatting and doing all sorts of fun things. He says, I'll come in too. So the 3 of us are walking, and we're walking up, and it's, we make it a few blocks, and all of a sudden I look over and Vincent is like shaking. And next thing I know, he's like hailing a cab, and he's like, and we're like, well, Vincent, what's going on? He goes, I should have known that better than to walk with a Russian and a Canadian on the cold.
That's a fair comment.
He tapped out like within 3 blocks. I was shocked. I was like, okay, I guess that's what happens. And, he lives in San Francisco or Oakland or whatever. So to him, this
fragile.
Was
he's fragile.
Yeah, he's fragile.
Dude, how about me? Like, I've been out of Canada for a couple of years. And I came back for Christmas, and we had that snowstorm. I was miserable. Jesus, like I was like, you know what? It's like there's a reason I bailed. It's like after a while, when you get used to the warm climate and you haven't toughened yourself up, it's a bitch.
Yeah, well,
to say the least.
I was so happy because it was like -1 in New York, and everyone's losing their shit. And I'm like getting reports from back home. It's like -10 with like wind chill or -15 and stuff. And I'm like, oh, thank God. I'm like, this is great. This is a huge uptick for me in terms of the weather.
It's the summer. Yeah.
I was happy to escape. I also over the holidays went down to my friend George Gammon's event down in Medellin. So I got to do New Year's down in Colombia. It was quite the party. That's
well, no wonder you've gotten all bulled up on bonds. You were with the Doom crew. Did you guys decide the world's ending? When did you guys decide the world's ending? Is it ending this week or next week?
No. I think you've got a little bit of time where there's a lag time.
Oh, okay. The world's not quite ending that much.
Yeah. We don't want. You never give a time period. That way you can tell the same story over and over.
That's right. Collectively, what was their target on the S&P? Was it above or below 2,500?
No, Jeff Snyder was there and Brent Johnson and stuff, but they were all talking in their typical kind of big picture cryptic thing. That there's no such thing as a target with them or short term kind of thing. I was the only one that was actually firing off actually
gave forecasts.
Yeah. That's not a thing. It's just not their style. You're never going to get that from them. That's just not the way they approach them. Yeah, they don't operate.
Well, Patrick, I'm upset I missed it.
Yeah, well, I'm sure you are. Look, I can see it in your face. You're just so upset. And it's all right.
Okay. Well, anyways, everyone, have a great week. We're back to the regular 2 weeks, so we'll see you in 2 weeks for the main show. And in the meantime, we'll have some great Market Huddle Pluses. Thanks for tuning in.
All right. Thanks, everyone. Cheers.